of the big questions that's coming up again and again is how can technology enable the creation and efficient distribution of green financial products? Well, this is one of the questions around impact financing that we hope to explore together with thought leaders. Patrick Odier, Senior Managing Partner of Lombard Odier, and Eric Lim, UOB's Chief Sustainability Officer, are a couple of those voices. And rejoining us again will be Vivek Pathak, who is Director and Global Head at the Climate Business of International Finance Corporation. He'll be moderating the session. Before the session actually starts, I want to remind you that you can participate in workshop and exhibition showcase sessions that are happening throughout the day on the platform. But otherwise, let's go to Vivek again as he talks to Patrick and Eric about impact financing.
Good morning, good afternoon, good evening, and a warm welcome to all of you all on the Sustainable Finance Impact Panel Series. Today's topic is impact financing. This is a very hot topic, no pun intended these days, and we've got two great panelists today to look at us, to help us go through this topic. We've got Patrick Odier, who is a Senior Partner at Lombard Odier on the investing side, and we've got Eric Lim, CSO of UOB on the banking side. So with that, let me kickstart the conversation today. The predominant financial instruments in green finance are debt and equity, and last year we had a landmark because green bonds touched the $1 trillion mark in cumulative finance since their inception in 2007. Yet the financing gap remains significant. It's estimated to be between 2.5 to 4.8 trillion, depending on how we account for it. So let me start by asking Patrick and Eric. Eric, you first. How do you think technology can enable the creation and efficient distribution of green financial products?
Yeah, Vivek, thanks for the question. It's a really good one. Because as I think about where technology can play a big role, I really see technology play critical capabilities and enabling capabilities around four areas. The first one is around the rise of sustainability data. And we all know in order to be able to make informed decisions, it's very important that we have the right kind of data. And around sustainability data, anything that makes it faster, more accurate, more available is going to help with the construction of green finance or investing solutions. A second area where I think technology can really help is around the distribution of ESG assets or investing. And with the rise of digital banking and the ability for digital banking to reach a much greater audience as well as a customer group, I think digital banking is going to be critical for the distribution of such assets. A third area, and this is something I'd be interested in hearing Patrick's view on as well, is around the use of AI or artificial intelligence as well as machine learning in helping portfolio managers construct the right kind of green or sustainable portfolios, as well as monitoring and rebalancing those portfolios. And finally, I think one last area to talk about is blockchain and the possibility of using blockchain to be able to democratize what were previously investable assets for large players into the hands of retail investors as well. So these are a couple of the areas I think technology can really begin to support the rise of green and sustainable finance.
Thanks so much, Eric. I think that was quite comprehensive, broad-based. Patrick, over to you. How are you seeing technology disrupt your business, which is, it's over 100 years old, very traditional in many ways, but we've seen technology coming in and picking up on what Eric said, especially using AI and those kind of tools. So what are you seeing happen in this space, Patrick?
Well, first of all, thank you very much for asking the question. I very much agree with the points that were made by Eric. I would add a few from an investor or investment point of view, I may. First of all, look at very basic things such as impact reporting. We are in a world where impact really will be of the essence. And that means that we need to rationalize the process within which companies, issuers in general do report about impact. So the impact should, of course, include how proceeds were used, which projects were funded, et cetera, et cetera. Also, most issuers are providing impact metrics for investors that basically will say what the climate impact, for instance, will be. And today, most reports really are published in a very different form, very classical form. And I think a digitalization, to make the point, of the impact report will make the work of investors and investment advisors such as ourselves, for instance, very much easier. So it's less disruptive than it is an advantage, I would say. The second point that I will bring is the harmonization of impact reporting itself. How do you make sure that initiatives such as the ICMA, a harmonized framework for impact reporting that was published 2 years ago, will really bring fruit to this process. And today, as you probably know, the impact reporting space is extremely fragmented and leaves a lot of space for interpretation, which creates internal confusions in the world of investors. And that should be something that we should take very seriously. Indeed, for instance, an issuer could attribute 100% of a project impact to the green bond that was issued, whereas, for instance, only 50% being financed by this green bond. This will be an area where we will all have to focus to make sure that there's no confusion about what we're really talking about. If I may take a third example, emerging technologies now, to go along your questions, leapfrogging from the digitalization step of the market, emerging technology can play a huge role in big data and natural language processing to use and analyze, for instance, the assessment of green bond and impact reporting. This would improve efficiency, of course, in the green bond market, but also tremendously improve the quality of the decision making. Secondly, and finally, emerging technologies can also, such as, for instance, geospatial data, can also help verify the existence of what absolutely has been done by the very funds that were raised by a debt instrument. And for instance, geospatial data validation can be used today to verify the existence of a solar cell park or verify the nature of a reserve of certain areas of the world nature is intact or has been replenished or regenerated. This new type of data validation can bring a lot more financing to those projects, and in this sense, it's a tremendous help and accelerator to impact finance.
Thanks, Patrick. I think you raised a couple of very interesting points. One is the importance of reporting, the importance of taxonomy, standards, data, so that people are comfortable that they are investing where they think they are investing. Let me build upon that, Patrick. You deal a lot with your private banking clients, high net worth clients. Are you seeing an increasing demand from them for these kind of products? And what is the general trend that you're observing?
Yes, indeed, we see an increasing demand. As you know, complexity in the field of the sustainability transition remains the name of the game, and it has to do with first having, of course, a vision of where the world is going, interpreting correctly this vision, and then declining this vision along a number of industries and then companies and issuers that you want to select. It has to do with the very scientific base on which you have to make judgment, and that's another theme which adds complexity to the process. So I think that while there is tremendous demand and willingness to have impact, we still lack a number of tools to make sure that we speak the same language. Therefore, taxonomies debates are taking place today and have absolutely to converge and come up to certain type of agreement, but also beyond the data we were just discussing, for instance, the methodologies through which you will take the climate issue, what will be the journey from today to tomorrow or to 250 of an industry or a company that you would select an issue from, and how well this issue is going to reach this objective, which is the metrics. If it is in climate, today we have temperature, and you have to develop methodologies to calculate the temperature. That's what we do, for instance, in our firm. But you could also develop and think of developing this very fast now for nature-related type of problematics, where the demand is also here rising very far. And perhaps the last point to answer, Vivek, your question, what I think is most interesting from our industry standpoint is that there's huge room for dialogue between not only region, countries, industry sectors, but also between actors of this transition in terms of choosing perhaps how then to finally, after all this is being done, agree on how to value the impact of one or two of the sustainability factors we're looking at into the company's financial. And that's where the next challenge is, in my view.
Thanks so much, Patrick. And over to you, Eric. Eric, you work for UOB. You've got clients right from large corporates to SMEs. Can you share with us the their perspective and how they're viewing this space as issuers? And again, how do you think we can get SMEs into this green space and get them to start issuing bonds or look at the green loan sector at least?
Yeah. Vivek, you picked up very well on the fact that when we look at the wholesale bank space, there are the large players and there are SMEs, and they are responding to the sustainability journey in very different ways. Large corporates who have, number one, all the resources to be able to understand how to transform and rebuild their business models towards a more sustainable future. They're a lot clearer in terms of the journey they want to be on. They're able to access large banks like us in terms of financing. And when they go to market and issue fixed income, these instruments are snapped up, right? So I would say for large corporates, going on the sustainability journey is a lot easier from a financing standpoint. The challenge becomes a lot harder for small to medium enterprises. For SMEs, they tend to be trapped by the ecosystem in which they operate. And the first and foremost concern of theirs is survival, right? Especially having gone through a very tough COVID period, as they're looking at rebuilding back their businesses. The top priority here is not figuring out the best way to be sustainable from a green or social standpoint, but to be sustainable first and foremost in maintaining their business model. And this is where banks like us begin to play a very critical role as a strategic partner. Because what we need to be able to do is bring sustainable financing solutions to them in ways that are easy for them to access. The way we do this, for example, in UOB, is we build ecosystem plays. We've got 3 of them. One called U Solar that focuses on renewable energy, largely solar energy. One called U Drive, which is focused on electric vehicle infrastructure, as well as EV financing. And one called U Energy, which is about energy efficiency for asset owners, right? And by bringing together ecosystem partners, for example, solar panel manufacturers to installers, to companies as well as individuals who want to finance and install such panels, we begin to support the journey of small, medium enterprises as well as individuals in making the right choices in terms of sustainability. And we think this is the key, because while large companies can crack it all by themselves, together with us, it's the small, medium enterprises and the individuals that need the most support and the most help. And that's how we see our role in helping our customers build a sustainable future.
Thanks very much, Eric. And I think that's something that's critical. And that's one thing that we are trying to do is what I describe is how do you green the domestic financial sector? Because the large banks and the MDBs like ourselves and the large funds, cannot really go and green SMEs. So you really need the local banks and regional banks like yourselves who are talking to SME by SME and figuring out, because if you don't green the SMEs and the small companies, I don't think we'll be able to achieve the 1.5 degrees that we're all committed to. But just let me ask a question which sometimes is considered controversial. Patrick, for you first. Are investors willing to live with slightly lower returns when their capital is invested in climate or green or sustainable products or impact investing?
Perhaps a little bridge, if you allow me, just to the previous question, to say also how important it is today to use whatever we have learned since the first green bonds were issued in 2008, as you know, to the benefit of the smaller either companies, SMEs, and or individual, but also to the more precisely defined projects. Basically, today, most investment offerings or green investment and thematic bonds are generic. Funds in general are funds that have global mandates. I mean, the norm is that sustainability investing is a global mandate and invests across fixed income asset classes, government, municipal, and corporate bonds. We have to try now to find the way to channel that capital to smaller size thematic bonds market, for instance, and to create also this ability and liquidity to develop opportunities for the smaller issuers, SMEs in particular, and perhaps the more defined projects to become part of this whole development. Now, of course, your question about the return against sustainability issue has been long debated. I think We are far beyond that point now. I mean, today, if we were not of the conviction that sustainably investing will create the most interesting investment opportunities for tomorrow, and probably will be the most efficient way to avoid the biggest investment risk of tomorrow, our fiduciary duty will simply not allow us to get into that space. So I think this debate about foregoing part of the return because one wants to do good with his money or his or her money is long being resolved. If I may sum it up, we are not here to have a moral posture vis-a-vis the way we invest. We are here to assume professionally and fully our fiduciary responsibility. In this sense, sustainably investing is the best way to go.
Thanks, Patrick. Couldn't agree more with you on the last point, especially. Eric, back to you. Are issuers expecting lower coupons and cheaper pricing because in their eyes they're doing the right thing? And there are costs to it very often, at least initial costs. So what's the perspective of the issuers in this case?
Yeah, Vivek, I've never met an issuer who didn't think that they needed cheaper pricing. So I think that's just a natural position every issue will take. Now, there is a reality around demand and supply. And I think the fact is there is more demand for green and sustainable issues than there is supply at this point in time. And this is a good thing because as the world moves towards financing more and more sustainable assets, green assets, we should start to see more and more issuances come up. And for that price discovery to naturally then find its price point. I think the slight discount you see today in the market is due to that fact that there is more demand chasing not enough supply, right? The second thing I will say is while we draw this distinction between green financing or green issuances versus conventional, I think over time that's going to be a fake distinction because increasingly business models will need to be issuing green and sustainable bonds or fixed income instruments because nobody is going to be able to 5, 10, 15, 20 years from now say that coming onto the market with a conventional bond that is not sustainable in nature because that's tantamount to admitting that your business model is not going to be sustainable, right, over the course of that tenor of that fixed income. So I think over time, we will start to see more and more conventional bonds become green and sustainable in nature to a point where just about the majority of the market will be green or sustainable in one form or another.
So I think we're coming to the end of our session. Let me conclude by saying, I think at the end of the day, we are going to see a movement in pricing for reasons that both Patrick and Eric mentioned because the demand is high. But also, I think when you look at certain things like climate, I think if you are taking into account climate risk and adaptation and resilience and even mitigation, there is a carbon price, which effectively means a person or a firm that's issuing green bonds is hopefully a lower risk than an entity which is issuing what I call traditional bonds or what I like to call brown bonds sometimes. And similarly, from an investor's perspective, I think, you are investing in an asset which hopefully has lower risk and therefore you should be willing to live sometimes with slightly lower returns. But I think we're reaching a convergence there where the amount of capital that is flowing into this space is higher than on the supply side. So hopefully we will have more bankable projects coming. And that's where in emerging markets, institutions like ourselves like to work with governments and partners like Patrick and Eric to make these projects happen. So with that, unfortunately, it wasn't a very debatable panel, or most of us agreed on everything. A big thank you to all of you all for listening, and I hope you all enjoyed this session. Thank you very much.